Good morning, ladies and gentlemen. A very warm welcome to you back on Business Today Television in our ongoing series of Diwali specials. We get to meet you, the finest brains on the Lal Street, professionals, fund managers, equity strategists who have navigated bull and bear markets with equal ease, are very comfortable with volatility, changed circumstances, as also the wild gyrations that the market often undergoes. In this series, we are very fortunate to welcome Mr. Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life Asset Management Company, where he's been helming the equity side of the business for the last 16 years. Before that, Mr. Patil was working with Motilal Oswal Securities, and since 1994 has been on the Lal Street. He's also worked with Parag Parikh Financial Services. A very warm welcome to you, Mr. Patil. Season's greetings, and good time as any to discuss sentiment on the Lal Street. How do you see at this point of time the major tailwinds that are benefiting equities? Are we going to have a good festival season as far as the Lal Street is concerned?
Yeah, a very warm welcome to all your viewers. Okay, and yeah, I think this festive season at least should bring some cheer. Okay, not only to investors but also to consumers, right? Because of the series of benefits, okay, which have been given, starting from the budget, really, right, where we saw the tax cut, which was given to salaried personnel, and then followed by the recent GST rate cuts. Also, the interest rates, the RBI has cut around 100 basis point the policy rate. That has led to decrease in the interest rates or the mortgage rate. So all that, I think, should help to stimulate at least the consumption side. And I think things should look better. So if you just go back a year and look at it, then in that period, last 1 year has been a period where the market has gone through a consolidation phase, right? We have seen that earnings growth has been tepid for the last 4 quarters, somewhere around the mid-single digits or so. And there were various reasons for that, right? We came from a very high growth period post-COVID. Then there was a slowdown. There was also a slowdown there was some fiscal contraction, okay, which we had in the last fiscal year. That impacted government spending. And the monetary policy also in the initial part was fairly restrictive. We were running a negative liquidity, and that really throttled the growth over there. But since then, in this year, this fiscal year, we've seen that the monetary policy has also been kind of accommodative, and we've seen rate cuts. The liquidity situation has improved. More importantly, the banking sector, which was also kind of stifled under a lot of regulations which came in from the RBI, and that leading to a slowdown in the credit growth. We have seen some easing of that also norms. So I think that should also, because banking system is very important in terms of not only lending credit, but also to stimulate the growth. So I think if you look at all the headwinds, and obviously we had the big tariffs which we imposed, right, on the US. We couldn't do a trade deal. So that also increased the negative sentiment. I think all those things are now priced in, right? So as we move forward into this second half of this fiscal year, we are more confident in terms of the earnings trajectory of corporate India improving back to around double-digit growth, somewhere around the 11 to 12% in that region. And I think that should really bode well for the market to really, again, get back the momentum which it had lost in the last 1 year. And also, I think as we move forward, I think you could see some amount of the high tariffs, okay, by US on Indian imports. We could see some kind of a negotiation there in the next couple of months. There's a lot of lobbying which is happening. And I think we could come back to some more reasonable tariffs over this. So I think, yeah, clearly, I think this festive season and this year onward, I think looks better than what it was in last year.
Fair point. Since you bring up the topic of earnings, and TCS kicks it up this week, followed by Persistent Tech, Mahindra, Wipro, and a little later in by Infosys on October 16th. What are the sectors, Mr. Patil, where your research team hopes that earnings will be ahead of expectations? You mentioned that an 11 to 12% rise in earnings is expected as far as the broader Dalal Street strategists are concerned. Where do you see outperformance? Where do you see pain?
So I think if you look at purely from the GST rate cuts and that what it could stimulate in terms of demand, auto is one sector where you could see upgrade to the volume growth, and also because of the operating leverage kicking in, you could see some margin expansion over here. We've already seen some one round of earnings upgrade in the auto sector, especially the passenger vehicles and the two-wheelers. But I would guess that if this demand sustains, right, and we are coming in through a period of couple of years of a down cycle in the auto sector, right? So there is some pent-up demand. There is a replacement demand also which kicks in because of the price cuts, and we have the again the pay commission, right? The coming in the next year, later part of the next calendar year, right? Which could also further sustain buying from the government employees. So I think auto and auto ancillaries, okay, because they would also indirectly benefit in the sector where we could see more earnings upgrade coming in over there. Apart from that, some of the other domestic sectors, like for example, the retail sector is also likely to see some discretionary spends going up. A lot of the benefits which are there on the savings, because the tax cuts partly will be used to delever the individual balance sheets. But also, I think the NBFCs and the banks are now gearing back to really lend to the retail sector. There was some amount of stress which was there last year on the unsecured lending. I think that is now kind of bottoming out. So with better availability of credit, you could see the consumer spending on retail and other sectors starting to improve. Again, sectors like, for example, cement, which is coming in from a very bad last year, okay, both in terms of volume growth as well as EBITDA per ton, is likely to show a pretty decent earnings growth, led by improvement in margins on the back of lower energy costs and some kind of a price increases going forward. And then other sectors like IT, which is again this year has been a kind of a last 12 months have been a very tepid growth. I think we next year I think you could expect that growth to again go back to around high single digit from around the low single digit growth what we are seeing. NBFCs again is another sector which can see the rate cut benefit transmitting through and improving margins in the coming quarters.
Okay, let's discuss the flagship scheme that you've been managing so well over the last 16 years. We are discussing Aditya Birla Large Cap Fund, the full name being Aditya Birla Sun Life Large Cap Fund. This was launched in August of 2002, somewhere like 28,000 crore rupees is 29,000 crore rupees is under management, and the fund has returned a CAGR of 18.7% since inception. If you were fortunate to have a 10,000 rupee SIP over the last 23 years, you would have given 27.6 lakh rupees piecemeal to Mr. Patil, and he would have converted that into 2.36 crore rupees. That, ladies and gentlemen, is the power of compounding, the power of buying quality assets at time when those assets are in pain, and of course holding them over the long term. Mr. Patil, given the background that you've just talked about, what are the one or two major changes that have happened in your portfolio under this scheme because of GST rate cuts, because of income tax rate cuts, because of the strong tailwind that we enjoy because of a good monsoon, and other factors?
Yeah, so in the last, if you look at a couple of years back, we had a very strong tailwind in the cyclical sectors, domestic cyclical sectors, including the industrials, capital goods sector, and the real estate sector also. So we played that fairly well in that sectors. But now we think that valuations in some in these sectors, and also the momentum which was there in terms of the growth is kind of slowing down. So we are moving from these sectors where we have had a very good run, and trying to move into the domestic facing sectors, both in the discretionary side, as I said. Autos is one sector where we have increased our exposure both in the passenger vehicle and in the two-wheeler space. We are also, I mean, we have been holding on to our exposure in the consumer durable side, which is still not really pulled up because of the monsoons, okay, which have been fairly bad, but we expect that to improve going forward. And then into the between the financial services sector, we have increased more towards the insurance sector, because that is a sector which, again, a year back, because of the taxation and other regulatory headwinds, it underperformed. But I think those are behind us. We are seeing again a steady growth of around 14-15% for the overall sector, and valuations there are fairly reasonable. So clearly, there is some shift from the domestic cyclicals, okay, towards the consumer oriented sector, and we have slightly reduced our exposure to the global facing sector, right, uh, uh, because of the trade talks which have fizzled. Except now, IT is another sector where we've been a big underperformer for the last 9 months or so. We are looking that as a contrarian bet over here, and the large underperformance gives a good entry point, we think, from a valuation perspective. And as the AI implementation in the US progresses, I think services sector would also be needed to really do the implementation, which we see that picking up in the next couple of quarters. So clearly, I think IT sector probably looks to be seeing the worst in terms of this growth, what we've seen in the last couple of quarters over here.
Absolutely. I think that was going to be my next question. Overall, if you see, Aditya Birla Sun Life Large Cap Fund has about 16.4% of its assets under management into the IT sector, and it's about 200 basis points higher than the category average, which is about 14%. So basically an overweight position, given the fact that many of these stocks, TCS, Infosys, Tech Mahindra, are at multi-year lows. So for value buyers and long-term holders like Mr. Patil, this is a golden opportunity
So,
to get back into
Bhattagar,
the
I would like
sector, which
to
has debt-free
correct over
companies,
there.
huge cash reserves. Yes, Mr. Patil.
Yeah,
Yes, sir.
slightly correction over there, because I don't think we are
Please.
as overweight as you are mentioning in the IT sector. I think probably also combining some of the new age technology names over there, like which we have. But the pure IT sector, we are more or less neutralish or slightly under, but we are trying to cover that now, reduce our underweight in that sector.
Okay, fair point. Coming to the new age space, Mr. Patil, because traditionally this particular fund has hugged the Nifty in terms of its holdings over a very long period of time. Uh, there is a marked absence of the internet space. I see a food services delivery company in the top 20. Pretty much that's it. Uh, are you very conservative when you add high PE, high growth stocks to this large cap portfolio? What's the reason for avoiding this space?
So we haven't really avoided. I mean, we had at various point in time some of these new age companies, but again, these are companies which are fairly volatile. The valuation sometimes, because of the euphoria, gets stretched. That's the time we really stay away from that. But at any kind of a market correction, right? If we see a good entry point in these very high growth companies, we are willing and open to really add to our positions. Where provided we believe that those companies are going to sustain their competitive advantage and continue to maintain their leadership, okay, in those segments. We typically go for the leaders, okay, in the new age, because that's where I think the whole value creation happens, because it's mostly the leader takes all in these new age, or at best the second best company in that segment. So that's our approach. And when we are really comfortable about their unit economics, because a lot of these companies are still not really profitable or probably just getting into profitability, but where we are very comfortable about the unit economics and likely to sustain, and where the competitive intensity is kind of slowing down, that's where we would like to enter in that segment. Obviously, we are not averse to high valuations, but again, we're slightly mindful of paying very high valuations, and try to strike a balance over there. And that's where we find some exposure in our portfolio, and we think that some of these companies are disruptors and they can create good wealth over the medium term.
Okay. Mr. Patil, one notable absence is the NBFC space. You've gone through the financial space via private banks and, of course, the largest public sector bank as well, SBI. But any specific reason for avoiding NBFCs at a time when you've had interest rate cuts, you've had income tax rate cuts? RBI has made it very convenient in terms of increasing the liquidity in the system, yet you avoid NBFCs.
So not really. Actually, we have been having some of the large NBFCs, right, which are there in our portfolios. You could see stocks like Bajaj Finance, Chola Finance, Shriram Finance, which are there, which have been good long-term compounders. They have been. I mean, we prefer to be in the NBFCs, okay, which are having uh, quite comfort on the liability side, very strong liability franchise, because that's where they get hurt, right? Whenever there is a liquidity crunch. So we are focused on the top quality NBFCs, and which are generating a reasonable return on capital employed and return on assets. Uh, uh, Increase incrementally, I would say that our view a couple of quarters back, okay, was slightly negative, because we were seeing a slowdown on the retail sector. The NPAs were increasing, but now I think with the rate cut, and also with the NPA concerns, especially on the unsecured, now kind of abating a bit, we are positively inclined towards some of the NBFCs. And within the financial service sectors, we have been fairly positive on the, as I said, the insurance sector. If you consider that also as these are non-lending NBFCs which are there. Not NBFCs, but the non-lending financial services companies, where our inclination is. But I think incrementally, I think some of the stronger NBFCs, okay, which have got a very strong retail franchise, and have a very strong on the liabilities side. I think those are the ones, okay, which we think will continue to grow ahead of the broader market and gain market share.
Okay. Mr. Patil, what would be that one very big bet, asymmetric bet that the AMC has taken on the market, either on the long side or the short side, given what we have gone through in the last 2-3 months, and given the fact that almost before sleeping, every Indian fund manager does look at Mr. Trump's Twitter feed?
So I think some of the, not asymmetric, but I would say the sectors, no, which we are taking some kind of a contra bet, right? Which
Okay.
Based on our framework where we look at,
Okay.
because I think for a large fund managers like us, we need to be slightly one step ahead of the market, right? Before a sector starts to really perform. So we are looking at a few sectors, like for example, the consumer staples. Again, we think is a contra bet, okay, which we can start looking at it now. Cement is another sector, okay, which we are looking at as a contra bet at this point in time, and and slowly moving towards some of these consumer sectors, right? Especially on the retail consumer durables are some of the bets which we are taking, primarily not from even a short-term GST, but more from a structural viewpoint that in India, you will see per capita income going up, okay, which is currently close to around $3,000 or slightly just below that.
Okay.
The young population is more aspirational. So we see a structural trend on the consumer discretionary side, and that's where is a asymmetric bet we are taking in that place. And and where we are underweight, I would say, is more on the oil and gas sector, where while the valuations are good, we don't see any major growth drivers over there. So that's a kind of a funding sector for us to play some of these better higher growth sectors.
Mr. Patil, one of the earliest movers in the global commodity space was Aditya Birla Sun Life AMC. I'm talking way back in 2007, 2008. You had launched two funds to look at the global commodity cycle. Now, 2025 has been traumatic for fund managers, especially equity fund managers, because we've seen a downdraft in equities and a 50-60% rise in gold and silver. So, at this point of time, what's the gut feel? Is the rally overcooked in these precious metals? How do you sort of look at it this from the point of view of a flat Nifty and a fabulous rally in gold and silver?
Yeah, so I think nobody would have thought, right, at the beginning of the year, right, gold and silver will give you that kind of return. And that's what happens, right? Any asset class surprises also on the upside, but clearly there are tailwinds for gold and silver because of the large demand which is coming into them from these central banks, which are now trying to build their gold reserves away from the dollar, and that is leading to that. And even silver also with demand coming in from EV batteries and other industrial usage on that side. And I think that I think demand from the central banks I think still continues. So that means that gold will continue to remain fairly stable even from here. But it will be really inappropriate for us to now expect similar returns from gold what we saw last year. So the way we look at it is that gold is or silver precious metals is a good asset allocation in your portfolio, which kind of it has a negative correlation at most times against equities. It gives you a good diversification. When equities don't do well, that adds returns to your portfolio, and say vice versa. And with that logic, I think it still continues to maintain that kind of allocation. We have a multi-asset fund or an asset allocation fund where we have our exposure to gold and silver. We had increased that to around 15 to 20. We still continue to hold that higher exposure. And I think increasingly, I think equities, again, which have underperformed last year, we think that this year, I think, should be a better year, as I said earlier, because of earnings growth picking up, valuation, especially in the large cap space, looking attractive. So I think it is now time to slightly more dial in risk into equities, I would say, and taking some gains from the precious metal while continue to maintain your asset allocation in these precious metals because they would still offer reasonable stability and some upside even from these levels.
Okay. Because one of the finest bond traders is at the helm of ABSL AMC, Mr. Patil, I'm just very gently trying to check with you. Is this purchase of gold and the presence of this precious metal ahead of euro in many central bank portfolios is now an active hedge against the dollar, or is it still a passive investment?
Yeah, so I think it is more to you're right. Again, we have seen that money is being pulled out of dollar assets, right? Because of with the trade war that has further accentuated, and there is a feeling that U.S. dollar, okay, would remain under. We've seen a weakness over there, but it will continue to remain weak. So that is also a kind of a hedge against. It's actually the other way, right? Money is moving out. People are wanting to diversify from dollar, right? In terms, especially central banks, and putting money into real assets like gold or precious metals. So that in a way is leading to the demand for gold, okay, and the price increase what we are seeing. So you're right in that sense that it is a move away from dollars, which is leading to the accumulation of gold and and then the appreciation in that sense.
Okay, fair point. What now, as far as the rupee is concerned, Mr. Patil, we've seen because of various problems with the US, of course, the pending depreciation that was due because of 2024 delays. What is the broader view on the rupee at this point of time?
So rupee in the last 3 months has seen good depreciation. I mean, significantly against the dollar, but also more so against the other currencies. Right? If you look at vis-a-vis the euro or the pound, there is a larger depreciation because dollar itself has depreciated against the other currencies, right? And now I think the rupee, which was slightly overvalued earlier, say around 6-9 months back, the real effective exchange rate, I think that has now kind of normalized. The pressure from the rupee was also from the fact that we have seen the net FDI, right, numbers being almost flat or negative because of the large pullout of money, redemption of money from investors, not portfolio investors, but the long-term investors which are invested into, say, private equity funds or even promoters of large MNC companies selling their stake and trying to capitalize on the high valuations over here to really meet their requirements globally. So that was also really pulling it down. But I think those pressures are now kind of easing off because the market also now has kind of is no longer as attractive for them to sell, especially the foreign promoters. And I think we have seen the net FDI numbers slowly improving. Oil also is now kind of trajectory is on the lower side. So our trade deficit is fairly under control, while the US tariffs impacts a bit on our exports. But again, that is not a very, very material thing. I think services exports still continue to remain fairly decent unless there is some more tariffs on that, which we don't think is likely to happen. So I think from here, I think the rupee should now stabilize. We don't expect any major outflow from India. FIs also, which have been selling, also the selling has now slowed down. They are now significant underweight on India compared to historical levels. And also now, as India's earning growth starts to improve corporate, I think there is no reason for them to really continue selling because relative growth for India should start to look better in the coming quarters. So I would say that the rupee should now probably stabilize here and don't see any major further depreciation unless the dollar appreciates, right? Okay, then relatively, yeah, it could. But otherwise, we think that should now kind of stabilize here after the sharp depreciation.
Right. Mr. Patil, time draws to a close, and as always, it's an exercise in education listening to your very calm, quiet, and wisdom-filled views. The best of festive seasons to all the unit holders of Aditya Birla Sun Life Asset Management Company, to your team, to you, and everyone at home. Thank you.
Thank you, pleasure, and happy festivities to all your viewers.
Okay. That, ladies and gentlemen, was Mr. Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life Asset Management Company. One thing that stands out is the bet that has been taken on the long side on the tech space, which has been beaten down badly over the last 2.5 years. Let's see how it works out over the medium and the long term. Thank you for watching, and here's hoping the best for festive spirits for our viewers. Thank you.
Legal illiteracy and injustice, the words used by the Indian Medical Association to describe the action taken against Dr. Soni, the veteran pediatrician who has been arrested in connection with the death of children who were administered cold riff in Madhya Pradesh.